Thanks for joining us for our podcast, Purdue Commercial AgCast. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and we're going to talk today about cash rental rates here in the state of Indiana. Joining us today are my colleagues, Dr. Todd Kuethe. He's a professor in ag economics and also holds the Schrader Endowed Chair in Farmland Economics here at Purdue. Michael Langemeier, who's a professor in ag economics as well, and also the Associate Director of the Center for Commercial Agriculture. So we're going to talk mostly about the results from the Purdue Farmland Values and Cash Rental Rates Survey, which took place this summer, and Dr. Kuethe directs that. Let's talk a little bit about the survey, Todd, how data is collected, and maybe how it compares to some other sources of information as well.
Yeah, so we talked about this a little bit in a previous episode focusing on land values, but it's also the same thing holds for the cash rental rates, right? It's a survey that the department has run since the late 1970s, where we get the opinions from people that are involved in farmland markets as part of their regular job. So appraisers, some farm managers, and also some lenders that are involved in farmland transactions. And we ask them about what they're observing in the county they operate, and then we sort of report state level and also in 6 districts. We ask about cash rental rates, sort of what they're seeing. We do a survey in June, so it reflects what's going on in that summer that we're observing. And so it's, again, the average for cash rent for their area, and we split it into 3 levels of productivity. So top, average, and poor. That's based on yields. They also report what's the expected long-run corn yield for that area, and what they're seeing for cash rental rates. Again, cash rents that are paid by farms. So it's like your typical lease of this is what they pay per acre, and it'll vary by on productivity.
So one way to maybe think about this is these are the rates that are perhaps best known or more, at least somewhat public with respect to people's knowledge. And from an economist's perspective, I might refer to those as the rates that are taking place on the margin. Does that sound appropriate?
Yeah. I mean, I sure hope it's at the margin from an economist's perspective. And then, I mean, the challenging thing with cash rental rates, it's the hardest thing, I think, to measure in terms of agricultural finance, in part because farms that are operating at a commercial scale or supporting at least one household with their income, they tend to work with a number of landlords. So they're renting from, it's not uncommon to hear of sort of a dozen rental negotiations that they're involved in. And so each one of those will vary a little bit based not just on productivity, but also their negotiation, maybe their relationship. We tend to negotiate rents typically every year, but those relationships last over a long time. So there's a little bit of carry over what that relationship's like. Do you trust the farmer or do you trust the landlord? And so it varies quite a bit. So the USDA provides an annual survey of cash rents reported at the county level, and they survey farmers. That's part of the June agricultural survey, which is mostly about production, but they also go about land values and cash rent as well. So they don't differentiate at all based on quality. They also just ask all the farmers, well, what do you pay, on all the acres that you rent? What's sort of the average? And so, when I used to work at the USDA, people would complain about, oh, these rents are not accurate. They're way too low, or everybody would rent at that level. And then, people will say, well, if you actually ask people that are involved as professional managers, farm managers, they tend to maybe have more negotiating power. And so their rents will be higher. And so it's one of those things that it's really hard to measure. There's also farmers have an incentive to keep that as a trade secret in terms of they don't want to compete too much with other farmers. So if you offer too low, someone else will bid against it. So they don't necessarily want to tell everybody what they're paying in rent. But they also rent from multiple people. So they also maybe don't want to rent too low and then they find out, I'm paying too much for others. So the kind of joke I always make in extension events is if you get tired of listening to a farmer talk, ask them what they pay in cash rent and then they'll be quiet. So it's a really hard thing to measure. And so we're trying to get as best information we can as to what's going on with cash rent in Indiana. But it's a very difficult to measure.
So with those caveats, let's take a look at the results from this year's survey. And we're looking at a chart here, Todd, that kind of gives us a little bit of history and perspective on these cash rental rates. The chart goes back to 2000 and then, of course, concludes with this summer's results from the 2024 survey. So, as you look at it, what were the changes that took place relative to last year and maybe relative to some of those historical periods?
Yeah, so we have a slight decline in poor quality land, but it's, again, just a very small change. Since about 2016, we've seen cash rental rates sort of slowly increase over time. And we still observe that for average and poor, right? So we went from, for example, 2016 at the average of $204 per acre. Now we're at 260. And then for the top went from 257 up to 313. So it's sort of been just increasing gradually. We had a couple of times where it sort of slipped a little bit, and maybe some years it kind of went up, but this year it's been relatively modest increase overall. But if you go back, 25 years in the survey, it's much higher than it was. Part of it is we had this really high period, mostly thinking about the RFS period, right? Where we had very high commodity prices. We saw cash rents move up quite a bit for several years, then sort of hold flat. Then we had a little bit of a dip. And then over the last sort of 10 years or so, we've seen pretty consistent increase up.
And so for clarity, Todd, you're looking at the results from the state average, right?
Yeah.
So these are all the observations you collected in the top, average, and poor categories, keeping in mind that people were able to use top, average, and poor based on their local region, right?
Yeah. Yeah. But I mean, ideally it should follow what's going on with production. It tends to equal out, and sort of, if you think about it in terms of bushel of corn that you put out, then that should be relatively consistent kind of across the state. That should hopefully be what's sort of driving the difference, right?
And I know based on some previous discussions, you've talked about the fact that these are really the results that perhaps you have the most confidence in because you got the most number of observations.
Yeah.
When we start talking a little later about the regional variations, less confidence in those individual region results because there's fewer observations behind each report.
Yeah. And that's part of it, right? Is that the number of people that work in work in farmland markets as part of their regular job. I mean, that number is decreasing over the years, right? And so we have just fewer responses. So it does make it a little bit where, it's a little bit harder to measure in some locations than the others. Usually the more you increase the space, increase the number of people that respond, the more I feel like, okay, that average is pretty representative.
So just to reiterate, so your top quality average for this year for the state of Indiana was 313. Your average quality rate for the state was 260, and the low quality or poor quality land came in at a state average of 204, right? So,
yeah. And again, when we're talking about land values, for whatever reason, that sort of like $25 to $50 threshold is what people really pay attention to. So being sort of, over 250, I feel sort of confident there. So what's over 250, maybe 260 might be a little too precise, right? Or 313. It's just a sign that we're over 300. People, I think, tend to sort of, a lot of the responses we get are sort of in those kind of $25 threshold.
Yeah, good point. So if you look at the percentage changes on a year-to-year basis, I think it's kind of interesting to think about it. First of all, thinking about what the yields are that people were thinking about on a state average in terms of how they categorize top quality, average quality, and poor quality. And then think about the percentage changes you're showing in those cash rental rates from 24 to 23.
Yes. This maybe shows a little bit better that, we're seeing a more of an increase in the top value, relatively flat or stable kind of at the average, and a little bit of a decline in the poor. But with each of those, what we've observed in the yield expectation, they're all increasing over time. But again, kind of expecting a bigger gain for the higher yield and a lower, more modest gain in sort of the low yield worthwhile.
Yeah, Michael, I just think it's interesting to look at the yield numbers, right? If you look at top quality land in Indiana, survey respondents are suggesting that average yield is in the ballpark of 226 bushels per acre. Average 196, poor quality land 167. I think you've made this point previously. Those numbers keep going up, right?
They sure do. And the average really is very close to the trend for the state. It might be 196 might be a little higher, but it's very similar to the trend for the state. And so I think that's always interesting to point out is, if you're looking for trend yield and what the cash rent would be for the average in Indiana, I think this average number here is very reflective of that.
Yeah. And in fact, if you look at the average estimate from USDA's most recent crop production report, it's actually a little over 200, right?
Yeah, it is. But we're over trend.
Right.
And I think, sort of going back to like sort of what numbers do I have the most faith in? I think we're better to describe the average for land markets and cash rents way more than we can. So I think there's sort of smaller amount in the top or poor quality that the average is maybe not just like the middle third. It's a bigger set of
Yeah, I agree with that. Right. That's good.
I don't know if this is just coincidence. I don't always believe in coincidence in economics. Usually there's something behind it. But actually, if you looked at the 24 crop budget, which back in March when we created this, there was the break evens were really looked high for the poor, and so it's no surprise that that's a downward adjustment. There was room for increase there. The average for average productivity, break evens were a little bit better, but they still were really high. It looked like you had losses, so only a small increase. For top, that looked a little bit better. It still was not an economic profit, but it looked a little better and had lower break evens, and so there was a little bit more room for cash rent increases. So I think it's very logical, given what we went through this year for net returns.
So, Todd, let's take a look at the regional results. And the caveat here starting off is recognize that there's going to be more variability based on the fact that you don't get as many observations in some of these regions, right?
Yeah. And I always sort of start with the idea that what we're trying to do is summarize what people are saying is going on in the market, right? And this should just be kind of a starting point when we think about what we're going to talk about for rents in the next year. But again, that negotiation takes place between the landowner and the farmer. I get calls from both sides, and no matter what we sort of report, half of those responses will be upset that it was either too high or too low. And so again, we're kind of seeing for most of the state, modest changes. We're seeing much higher increases in that southeast region, the largest declines in that southwest, but that's also the area we get sort of fewer responses. It's not quite as much land that's just dedicated to agriculture. Also, the more diverse in terms of like crop mix that's possible, I think, than we tend to see. And that when I think about sort of, Corn Belt economic dynamics, that west central region, I think is the most representative in terms of what we see. And they're relatively stable, right? In terms of not sort of large moves in cash rents from the previous year.
Well, maybe with one caveat, I think in the central region, you're picking up some significant increases, right?
Yeah, I guess I should, clarify. Yeah, the central region a little bit more.
So, and I think if you look at the central region, the average rate for average quality land was up about 10%. That put it at 275. Top quality land in the central part of the state was up 5% at 310. And the poor quality land, Michael, this was kind of interesting. We saw a fairly big adjustment on the poor quality land in the central part of the state. It was up almost 13% at 238. But maybe that could be a reflective of differences in what people perceive to be poor quality in the central part of the state.
Poor quality in central is not the same as poor quality in southeast. And
Yeah.
so we always got to remember that. I think even though the percentage increases were higher in central this year than the west central, I think if you look at the numbers between the two, they're very consistent. I agree, Todd. Those are the areas that are most like Illinois and Iowa. If you're looking at some information from those two states, and I think they're very consistent with one another in terms of the top is 310 in central, 327 in west central. Average is 275 in central, 278 in west central. So maybe looking at 1 year rents is always a little dangerous, but it seems like to me that they're very consistent with one another this year.
So, Michael, we've been asking people on the Ag Economy Barometer what their expectations are for cash rental rates in the upcoming year. And we've asked the question 2 months in a row. We asked it in July and we asked it again in August. So parallels pretty closely with when Todd was collecting data. And at least the first time out of the box, maybe we were a little bit surprised. You might look at those results for us.
Yeah, I'm still a little surprised. Essentially 70% in August and 72% in July said that cash rents would be about the same. It's hard to tell what they interpret about the same. Is that a tight band around zero? So we don't ask that specifically. At least we didn't on this survey. And there was only about 15% both times that thought cash rent was going to be lower, and that's what surprised me a little bit. If you look at net returns and prospects in 25, they don't look particularly good, and 24 it doesn't look particularly good either. And so I would have thought there had been a few more that were thinking about lowering cash rents, but we're going to get into this here in a little bit here. And as we always say, you can't just look at 1 year of low returns and say, well, cash rents are going to go down that next year. It's a little more complicated than that. you really need 2 or 3 years of low net returns to land before the market seems to say, yeah, it seems like we're in different times now. Perhaps we need to adjustment of cash rent. And we're going to post these slides here. One of the slides I really want them to take a look at is a slide that looks at cash rental rate and compares that to estimated net returns to land. It's for West Central Indiana average productivity, but this would be a very typical relationship for any part of Indiana and probably Illinois and Iowa too. Show a very similar relationship, and cash rent just does not adjust very fast. It's very stable compared to net return to land, and so you'll see net return to land $100 to $150 difference in 1 year. Cash rent just doesn't adjust that fast. But having said that, 2021 we had over a $500 estimated net return to land, and so what that net return to land means is every cost except for land is out of there. That's a pretty high economic profit. Then we dropped to about 350 in 22. In 23, we dropped to 185, and 24, my projection is around 70. And so obviously we've really dropped those net return to land over the last 2 or 3 years. And so I think we're setting ourselves up for some downward pressure in cash rent in 25.
Yeah, so when I look at the chart and listen to you talk about that, Michael, I really think about the fact that what cash rents do is they really smooth out the changes in the returns to land that take place on a year-to-year basis. Returns to land on a year-to-year basis can be extremely variable. Cash rents don't vary nearly as much, but they do respond over time to changes in net returns to land. And I think that was kind of your point with not only this chart, but all some of the other research that you've done over the years. We do see a response in those cash rental rates, but it's not immediate. And so from that context, maybe the results we got from our Ag Economy Barometer survey make some sense. Even though 24 is a pretty weak year, maybe we won't see much response in 25. The response could actually show up more along the lines of 26. And if you look at history, looking at your chart, that's exactly what happened back in that, 2014, 2015 era. We had some relatively weak returns in 2014, 2015. We didn't see much change in cash run rates until 2016.
Yeah, the chart looks very similar. If you look 2011 to 2014 and 21 to 24, it looks very similar. And you're right. It took a year or two, a year too longer than you might expect to see the reduction in cash rents. And this makes sense because, cash rents are negotiated, and before someone's going to define a new normal, it takes a while to convince people that we're in a new norm.
Yeah. I also think it takes a while for the opportunity cost, right? Where you're willing to walk away from land.
Yes.
Right. To say like, I just can't afford to keep
I can't do
doing this.
yeah.
Right. Where you're saying, well, as much as we maybe think 25 might be a down year and it'll be another year to put, there is a group that's sort of hopeful of like, well, maybe 25 is when it's going to turn around and I'll be glad to have had it. It's not quite a strong enough signal to really to change my behavior.
Yeah, good point. So, Michael, you've taken a look at something else that kind of helps us put the relationship between cash rents and farmland values in kind of a long-term perspective. So let's start off by defining a couple of terms here before we start talking about the results.
Yeah, what I'm trying to compare next here is the farmland price divided by the 10-year historical cash rent. So we take farmland price, then we take the previous 10 years of cash rent. That's one number. And then I do the same thing for net returns. Farmland price divided by the previous 10 years in net returns. Why 10 years? Well, I'm trying to look at a longer time period, and you'd expect in a longer time period in economics that these two numbers would be very similar. That 10-year average cash rent would be similar to 10-year average net return. If there's a lot of difference between those two, then you think, well, maybe we need some adjustment here, either probably to cash rents, because we can't do much about net return to land as far as adjustment, but maybe we need some adjustment to cash rents. And what I'm seeing right now here is convinces me that chart that we talked about previously, where we're seeing some downward pressure on cash rent, is very real. Because if you look at these two numbers, P rent 10 and P net return 10, you're looking at a rent 10 of $300 and a 10-year average historical net return average of $273. That means that right now the 10-year average rent is $25 approximately over the long run net returns, that again tells me that we're probably looking at some downward pressure to cash rents. Cash rents are a little higher than the historical net returns, and it's very consistent. I run a regression. I run a statistical analysis where I look at current cash rent in relationship to lagged cash rent and net return to land. And that regression is also telling me that there's some downward pressure in 25 and particularly in 26. And so all of this is consistent. I might be consistently wrong, guys, but all of this is consistent, saying that there's some downward pressure in cash rent. Now, whether that'll occur right away in 25, we already talked about that. It might not. If I do it, I'll just stick my neck out here. If I had a best guess for what the 25 might look like, I'd say 0 to down 5%.
So, Michael,
So a
maybe
small adjustment.
another way to think about this is we really don't see any reason for any upward pressure on cash rental rates in 25.
No.
If there's any pressure at all, it's going to be the downside. But what we're saying is that based on history, we think that downside pressure will be less than you might think,
Yes.
given the collapse that's taken place in net returns to
Yeah.
land.
Well, I think it's sort of consistent with what the respondents for the barometer, and as me looking at this as an economist, to say, there's been about 5 years now where that P rent 10 is below that.
Yeah.
But there was also about a 15-year period there
Yeah.
from the late 80s till about 2008 where it was also below. Right?
Yeah.
So
yeah.
like it's not like it's going to be a one-to-one immediate adjustment. So even if there is downward pressure, we may not really realize
Yeah.
it.
That doesn't mean adjustment is 25. That means the adjustment is long term.
Yeah.
Yeah.
So we've observed that sort of gap for long stretches of time in the past. And so it's not that we're going to necessarily see the market immediately respond.
So, Michael, you also took a look at the same relationship, except looking at the stock market. And that's kind of interesting to contrast what's taking place in the stock market when you look at the price earnings ratio, when the earnings are averaged over 10 years, relative to what's gone on in farmland. It actually explains some things in terms of why people are interested in investing in farmland.
There's two things that I find very interesting. What Schiller calls the cyclical P/E ratio, or PE10 is another name for it. So stock price divided by previous 10-year earnings. And so I'm just mimicking Schiller for cash rent and net returns here. But there's two things that I find very interesting. First, the PE10 is quite volatile. The stock market is quite volatile compared to the farmland market, so that's no big surprise. But the other thing is there's not a close relationship between the stock market and farmland market, and we know this, but I think it's always important to reiterate that. And so if the economy goes into recession here in the near term, that does not necessarily mean ag's going into recession and vice versa. And so we always got to keep that in mind when we're looking at the stock market. There's not a close relationship between the stock market and the farmland market. And as research has shown, essentially the correlation between farmland prices and the stock market is very close to zero.
Yeah. In fact, if there is any sort of movement at all, it's occasionally sort of shows negative correlation, right? So one of the reasons farmland is great to own is that it adds a lot if you have a diverse portfolio of a bunch of things that you own, right?
Yeah, and it explains why non-farm investors in particular have some interest in owning farmland, because it does diversify their portfolio away from stock market returns and actually kind of smooths those returns for their total portfolio, right?
Yeah, particularly if you look at sort of, things like, pension funds or, the life insurance companies that want to have a broad, long run holding, it's great for it.
So, Michael, you've taken a look at the farmland price to cash rent multiple for West Central Indiana, and that's an interesting chart. It's related to what we've just been talking about, but it may be, and for some respects, might be a little easier to understand.
Yeah, let me talk about this in a couple different ways. I'll start with the capitalization rate, which is cash rent divided by farmland prices. And then I'll flip it around to do the P rent ratio. They're the inverse of each other. If you look at the long run average capitalization rate, and this is going back to 1960, it's 4.5%. There were some times during that, it was over 5, but the long run average is 4.5%. And then recently it's been quite low. Recently it's been 2.5%. If you do the inverse of that, what you find is the long run price to cash rent multiple, so farmland price divided by current cash rent, is right now we're sitting at approximately 40. And so obviously the P rent ratio is relatively high, but that's because the capitalization rate is relatively low. And we probably don't want to get too far into the weeds here why the capitalization rate is relatively low, because that's a very complicated number to talk about. But one of the reasons, obviously, is since 2008 until recently, interest rates were very low. And that really created a situation where the cap rate was pretty low for not only for land, but for other assets too. And also created a situation where the the PE ratio were relatively high. And so really, if you're thinking about where this is going in the future, it really depends on where you think interest rates are going in the future. And, even though we had a relatively large increase in Fed funds rate and other interest rates recently, the Fed has signaled that they want to take 1 to 2%, I think 2% in the next 2 years off of those increases that we saw in the last year. And so that would lead me to believe that if, to the extent that there is upward pressure on long run capitalization rate, downward pressure on the P rent ratio, it's not real strong pressure. And so I think that cap rate at 2.5% is probably going to stay that way for a while. At least that's my read.
Yeah, so the chart is interesting when you look at it. And for listeners, if you haven't had a chance to do so, I'd encourage you to download the slide deck that accompanies this podcast. The chart, at first glance, suggests to the casual observer
that we're paying too much for land.
I'll include myself in that category. It suggests we might be at a peak. And your argument is that could be true, but you think reductions in interest rates over the next year or two could actually be supportive of that. In fact, a big chunk of that run up in that PE ratio is attributable to the fact that interest rates in recent years have been so low, right?
Yeah. Now, one of the things that we did see, if you go from 2007 to 2014 in particular, both cash rent and farmland prices increased dramatically, but farmland price increased much, much faster than cash rent. And that was because of those low interest rates. And so we are in an environment now, if the capitalization rate is going to be relatively steady, that cash rent and land values are going to move more similar in terms of percentages. I think we're out of that period, at least from an interest rate standpoint, where there's more upward pressure on farmland than there was cash rent. But we went through a very long period where that was definitely the case.
Well, I think there's a couple. I also think about the long holding period that we tend to have for farmland ownership, right? Because in some ways, this number is also a way of thinking about how much would you pay to have this access to farmland returns, right? Rental rates, right? So if I was going to buy it and rent it out, that if I was going to own it for 40 years, then I'd feel pretty fine about it, right? Is sort of one way that I think about it. But then I also kind of think about it in terms of, how there's also the part which is like the appreciation of the asset, like that sort of capital gain that you could get, right? And how much that's maybe a driving influence, right? So there are times where, the cash rent is great because, it gives you some positive return, even if the market price is going to go down. If you don't realize it, you'll still get that gain, right? But like it sort of fits into this idea of kind of this cap rate in general suppression, I think, across the broader economy. It's not sort of unique to the agricultural sector. But what is unique about ag is that long holding period. And so you have, historically, you've kind of modest returns from owning farmland, but like it's a really great retirement source to own because the capital gains will be high over that sort of 20 to 30 years.
And that's been particularly true, as we were talking before the podcast, since 2007, and maybe a little bit before that even. That's been particularly true during this most recent 15 to 20 years, is the cap rate as a percentage has been much higher than the capitalization rate. And so holding land has been a good idea.
So I think 2 points that we were discussing before the podcast. Todd, you mentioned the fact that the low cap rate influenced asset values across the board, right?
Yep.
That was positive for asset values. And then the related point was, and Michael, you were talking about this, looking at some of the USDA data with respect to how much of the gain of owning farmland over long periods of time is attributable to the increase in asset value versus the income generated, or stated another way, thinking of it, of the income generated as being like a dividend.
Yeah.
How much is coming out of the dividend? How much is coming out of capital appreciation? You looked at those numbers.
Yeah, it's a rate of return that USDA ERS computes for the farm sector. They have a farm sector balance sheet, and of course they do the income statement, the net farm income forecast also. But this is another thing they do is they calculate a rate of return, and they break that rate of return into current income, which it's analogous to cash rent. You know, even if it's as an opportunity cost, even if you own the land, but the current income and then capital gain. Most of the capital gain, if not over 90%, would be attributed to farmland. And what they've found here, looking at the last, again, since 2007, that's what I always look at the start of the ethanol boom. 2/3 of the rate of return has come from capital gains on land. 2/3. And so, and so it just stresses the importance to farmers to having farmland on the balance sheet.
Yeah, good point. So with that, I think we're going to kind of wrap it up for today's podcast, Michael. So thanks for joining us, Todd and Michael both. You can get a little more details with respect to the land values and cash rental rate survey information on our website, which is purdue.edu/commercial-ag. And if you're not already a subscriber to the podcast, if you're listening to this on the website, you can subscribe. Any of your favorite podcast providers would have the podcast available. When you search for it, just remember to search for Purdue Commercial AgCast, and it should pop up very quickly. So with that, I want to thank both Todd and Michael for joining us. And on behalf of the Center for Commercial Agriculture, I'm Jim Mintert. Thanks.